It's time to get started. So thank you all for joining us. It's a great pleasure to have you all with us, and it's especially a great pleasure to have our panelists and guests with us. Thank you for joining us for our first ever hosted webinar in partnership with PGIM. So it's a great delight to do this in collaboration with PGIM, which is wonderful. And I'm looking forward to the discussing what is next in sustainable investing and how can data better support the growing needs of our investors across the industry. A little bit about myself before I turn it over to our panelists to introduce themselves. I'm Patrick Uribe. I'm the CEO at UTIL. If you're here, you know something about UTIL already, which is that we measure the impact of companies on the world using an evidence base of academic and scientific journal articles. It gives us a solid grounding in scientific consensus when we measure what impact companies actually have on the world. And we do this for asset managers, investors around the world, in the hopes of making sure that their investments are better aligned with what they care about. So that's a brief intro about us. The true stars of the show are our panelists who are here today. So I will turn it over to them to introduce themselves. Perhaps first we could just start with Laetitia Hamon, who is here with us from the Luxembourg Stock Exchange. Laetitia, if you could say a few words about yourself, that would be wonderful.
Thank you very much, Patrick. And first of all, thank you very much for inviting me. I'm very pleased to be here, very honored as well. So just on me, I'm the head of sustainable finance at the Luxembourg Stock Exchange. And that means that I'm leading the Luxembourg Green Exchange, which is our dedicated platform for sustainable debt securities. Before that, actually, I've always worked in sustainable finance since before the financial crisis, 2008, working for ESG rating agencies, working for ESG information services. And before the stock exchange, I was an auditor and advisor on sustainable finance as part of a Big Four company.
Wonderful. Thank you. Gavin, perhaps you could go next and say a few words about yourself.
Absolutely. Thanks, Patrick. And hello, everyone. So I'm Gavin Smith. I'm head of quantitative equity research and sustainable investing at PGIM Quantitative Solutions. So with my sustainable investing hat on, my team drives all ESG related research, ESG related product development research as well. But with PGIM Quant, we are quantitative equity and multi-asset specialists. We've been providing solutions in this space for over 40 years to our clients. Thanks, Patrick.
Wonderful. Thank you, Gavin. And last but not least, James.
Thank you, Patrick. So hello, everyone. My name is James. I am a portfolio manager at Titan Asset Management, working alongside other members of the very talented investment team. And here at Titan, I am primarily responsible for our approach to sustainable investment. That role covers inputs to the investment process, like the design of our investment policy, as well as the selection of research, data providers, those sorts of things. Moving forward, the construction and ongoing management of our sustainable investment proposition. That's things like asset allocation, security selection, and then finally, outputs like market commentaries, general reporting, collateral, investor initiatives. In a phrase, it's a farm to table service.
Wonderful. Thank you, James, and thank you all for being with us. This is great. I'm very excited to hear your thoughts over the coming almost hour that we have together. I'd like to start actually around this topic of client demand. Speaking of farm to table, we'll talk about the diners at that table, so to speak. And we've been hearing a lot about the scrutiny around ESG, around tightening regulations across sustainable funds in the last few months. But I'd like to start by asking all of our panelists, and perhaps Gavin, I could start with you. How has client demand for sustainable investing changed for you over the past year or so? What are you seeing?
Yeah, we've very much seen this evolution in preferences from traditionally very much more focused in ESG to people being much more aware of sustainability impact. That's really why we're here today. But for us, there's been several underlying driving factors driving that evolution. One has clearly been the regulations, as you've spoken of, this focus on how you define sustainable investments with UCITS funds. That's been a big one. But even outside of that, we saw last year a major ESG index get rebalanced and a prominent stock get excluded from that, criticism from the company's founder on that. That led to a lot of confusion, discussion around this distinction between ESG and sustainability. And that led to investors, I think, really sharpening their preferences in terms of what they want from strategy. So that ended up being quite beneficial. But another factor driving this evolution has been this increased awareness of double materiality and how people start thinking of that and executing on that, from what's good for the company, what impacts the company, through what impacts the world and society. And so that's led to that blending of these concepts of ESG and sustainability or impact. So this might be one big area where we've seen evolution, but there's been two other areas that we've seen really change last year. One of these has been a broadening in the demand, or a broadening of the preferences of investors, I should say. So previously we'd seen a lot more focus on decarbonisation related issues, and net zero driving that. The last year we saw preferences and interest evolve into areas like biodiversity and water, which has been encouraging. Another change in demand is that we've seen an increased preference of moving away from just simple solutions in this space to more sophisticated solutions. We saw last year with certain market dynamics, these market dynamics significantly impact certain ETFs in the market, which have, say, exclusions implied in them in a very naive, simple way. Investors looking for better ways to reflect their preferences where they don't have some of those performance issues then. But in terms of this move from simple to sophisticated as well, what we've also seen is investors interested in not just risk mitigation approaches or a negative approach to building strategies, avoiding the worst offenders, through more of a positive approach, pursuing opportunities now. So it's been this nice evolution, almost like signs of maturity or maturation of this space, which has been encouraging of the year.
That's very, very interesting. Thank you, Gavin. Laetitia, are you seeing? I noticed you nodding. Are you seeing something similar on your side?
Yes, I was nodding because, in fact, regulation is absolutely a crucial element where we see a lot of demand, a lot of alignment or trying to answer to these new regulatory requirements. And on our side of the ocean, there are so many regulations that impact asset managers. I will spare you the nice acronyms of those regulations, but there are so many that it's a big trend, actually. Asset managers are trying to align to that. But what we see on top of that is, and that's linked to the geopolitical context that we experience here, and especially the energy crisis, we see a lot of demand also related to renewable energy, and especially energy infrastructure projects that could be financed to support the transition to a low carbon economy. So that's one thing that we see. The other element that we see, and that's more on the debt side, because I heard Gavin talking about the fund side, on the debt side, on the bond side, what we see is that there's more attention to the allocation and impact reporting of issuers. So whereas in the past we were seeing asset managers asking for a list of labeled bonds, now they ask for the allocation, they ask for the impact, they are more informed, more sophisticated on those points as well. And there's also more demand for innovative products. So Gavin mentioned a few of them related, for example, to biodiversity. What we see on the bond side are the attention on bonds like the gender bonds, so bonds that have a gender lens, if you wish, and also blue bonds. And I was talking, as I said earlier, in a panel with Cabo Verde, which is a small island by Africa. They have a blue exchange. That's wonderful. So, and Uruguay actually issued recently a blue bond to finance biodiversity in Galapagos Island. So all of that is very innovative, and that's what we see going forward. But of course, regulation is also there. Is key.
Right. That is absolutely fascinating. James, how about you? As I think about your farm to table analogy, what is is your menu reflecting something similar?
I think from the point of view of a UK-based discretionary fund manager, I think it'll end up being a little like Hemingway's quote about bankruptcy. What we've seen over the last year or two is a slow and steady increase in demand for our sustainable investment proposition. Most of our clients, who are predominantly financial advisors here in the UK, are starting to receive more inquiries about sustainable investment opportunities. I think that's in part transfer of wealth, generations. I think people my age, I don't really speak to anyone who doesn't care about these sorts of things. I mean, to echo what Laetitia and Gavin have both said about regulation, if IFAs are being asked a question, they're also now being asked by regulators to ask the question back to their clients about whether or not they'd like to consider those sorts of things. We've also got, obviously, SDR coming in, trying to take the best bits of SFDR, trying to move in the right direction. So, I mean, in aggregate, what has been a slow and steady journey so far, I hope all of a sudden will become a deluge of RFPs coming our way. You know, I think to echo Gavin's point, the conversation that we've been having internally and also with our clients has gotten smarter, it's gotten larger, and that's a function of just there being far more interest in this space than there were even just a few years ago.
Well, that is absolutely fascinating. Well, and Gavin, perhaps we can return to you for a second. How do you go about meeting these sort of changing demands? What is it that as you see these things happening, how are you then adjusting?
Yeah, one of the things we've done a lot over the past 6 months or so is focused on education. That's been a big area, as there has been, you know, this journey to better understand this difference between ESG and impact. We've done research to say, do ESG scores explain impact scores, for instance? Are the concepts related or are they distinct? We found very little relationship between the two. And so this research is helping investors better understand the differences and appreciate how those two different insights can actually complement each other. So education has been a big part of what we've focused on. The second thing we've done is we've invested in more data. As investor preferences have broadened,
right.
we've had to keep up in that and focus on expanding the data we use on the ESG side to keep up on that, but then also on the impact side. So that's going to be just an ongoing aspect of this space as, you know, data continues to evolve. But reflecting almost this trend of simple to sophisticated, we've also focused a lot more on portfolio engineering. So having that data to keep up with those demands and preferences is one aspect, but you still got to deliver the solution at the end of the day. So we've been doing a lot of work on the portfolio engineering, construction. How can we better incorporate these investor preferences into portfolios, balance that against other risk and return outcomes then? So it's been those three areas that we've really focused on to respond to those demands.
That's really interesting. Laetitia, I'm curious, you mentioned some of these other exchanges with blue bonds, etc. How are you adjusting at the exchange to what you're seeing in the market?
It's true that when we started LGX in 2016, we started with a platform that were displaying green bonds. But we have enlarged that quite substantially in terms of the products first, but also in terms of the other services that we provide now. So on the point of Gavin, for example, the education side is absolutely crucial for us. And that's why we've launched the LGX Academy. Having everybody understand what is sustainable finance, what are the products, the standards, the regulations, all of that is absolutely crucial if you want issuers to issue more bonds and shift their money towards sustainable assets. So that's one point that is very important. On the data side, we've got a strong focus, as well as I mentioned, we see new innovative products like the SLBs, gender bonds, the blue bonds. So every time there is something like that, we try to identify them and to flag them. We don't want to create additional labels, but we try to flag those bonds so that investors can see them, can be sure that there's more trust and credibility around those ones if they meet our criteria. And in the data hub that we have, we've got a huge database of GSSS bonds in there. What we try to do is also address the question of regulation by adding some data points. For example, we've added points on the EU taxonomy alignment because that is something that is required now. So investors need to understand how aligned their bonds are to the EU taxonomy, for example. And the last point on the impact and allocation is that we've developed a way of aggregating all this data that we have in the data hub at a portfolio level. So you don't just have information at bond level, which is already complicated to get, by the way, but you get it at portfolio level as well, so that it's more usable for asset managers who can decide on how to invest. They can report on their portfolios and that kind of thing. So there's a lot of innovation around following market trends and how we extend our services and extend the range of the data.
Okay, that is extremely interesting. James, I'm curious. I might refine the question a little bit because I'm seeing some patterns emerging here too. But I imagine you have a range of investor preferences that you're serving. Do you see some of the same patterns for yourself? And you know, what does that range look like?
Yeah, it is tough. Yes, we ultimately have a one-size-fits-all policy, and we found it to be a real process of collaboration with our clients to arrive at a one-size-fits-all policy that meets as many client preferences as possible. And I mean, couldn't agree more with Gavin, Laetitia. Education has been a crucial part of that process. Simple things first, like separating out the various acronyms. I mean, different things to different people, trying to get everyone on the same page. Materiality, I think Gavin mentioned, single, dual, dynamic, explaining these concepts and how they work together. ESG ratings on one side versus impact metrics perhaps on the other. And then once we've kind of set the scene, we've got to then explain how we approach sustainable investment, which is, quite simply a combination of integrating non-financial data into our investment process, so risk of the world on companies, governments, etc., and then allocating to what we see as best-in-class strategies from across the the spectrum of capital, sustainable investing landscape. Most recently, our focus has probably been on building narrative. It's one thing having the proposition and having everyone on the same page, but really communicating the value add, the sustainability side of the story, in addition to just the simple risk return stuff. That's a combination of commentaries about the sustainable investment ecosystem, case studies about how we allocate capital, and of relevance, data, trying to find the most simple and exciting way to communicate what can sometimes be quite dry data, complicated data, in a really powerful way, in our monthly or quarterly commentaries. So that's what we've been focusing on lately.
Okay, that is fascinating. You've all mentioned data, and that was actually going to be my next question if you hadn't all brought it up anyway, which was, how does data fit into this picture? And I think, obviously education is one thing, but we are, we're also dealing with, the necessary data points to back up some of these choices, to meet some of these different demands. How does data fit into this picture? James, maybe we could ask you to continue first, and then we'll work through the other panelists. But how does data fit?
So, at a high level, in two ways, as an input and as an output to our investment process. On the input side, it informs our sustainable investment policy. The purpose of which is simply to separate our investable universe of primarily funds, exchange traded products, into opportunities that do represent a sustainable allocation of capital and those that don't. So we use data on the input side. And then on the other side, output. So I just mentioned narrative. It's ultimately very important to communicate what we're trying to achieve with our proposition. And so on a monthly and quarterly basis, we're using data from a variety of providers, including UTIL now, which we're very excited about, to try and build that narrative and explain how we go from investment policy to investment proposition, and then the outputs.
Fascinating. Laetitia, how about you? I know obviously an exchange data is flows through it. So how is it changing for you when it comes to data?
Absolutely. So we're not an investor per se, we're a market operator. So we're in between investors and the issuers. That's our position in there. However, data is absolutely central to our activities and to our business. One, because market data is at the core of what we do. We sell market data. So we started with financial data, but now we also sell ESG data or ESG related data, more specifically on the bond side. So that's one thing, but it's not all at all. What is most important for us when using the data is our own sustainability strategy, the strategy of the exchange, because we've got the green exchange, which is already a good thing, but we need the entire exchange to transition. And for that, we need to have some sort of ESG data or sustainability data, however you want to call that, into different operations that we have. We need to have that for our compliance purposes. So on top of doing AML, KYC checks, we need to be sure that the issuers that we onboard on the exchange do not bear a substantial ESG reputation risk for us. So we need that type of data, for example, in there. When we go and travel the world to meet potential issuers, we want to make sure that we do not attract those that will be involved in stranded assets and are not transitioning at all. So we also need that information in that side. On the communication side as well, of course, we want to make sure that we give visibility to those that have concrete actions in that transition as well. So there's a lot of use cases within our exchange, and it's not only the selling side of it, all the use that we have internally everywhere in the exchange, so that we can transition. So it's a fascinating topic. There's a lot of cases, but there's also a lot of set of data, and sometimes it's a bit confusing as to what can we use in that sense.
Well, and actually that may be a question directly for Gavin. I mean, this is you mentioned all of the various different ways that on the quantitative team. Quantitative to me is virtually synonymous with data, so it feels like data's got to figure in there pretty importantly. How do you factor data into all of this?
Yeah, it's very important to us, and we are a quant. We focus on data. It's a good ask for me this question last, actually, probably Patrick, so I don't take up too much time. But yeah, like data is critical to everything that we do as a quant. It's the foundations, pretty much like garbage in, garbage out. If we don't have good data, investors can't have confidence in our products. So I made the comment, we have significantly expanded the data we're using in many different areas across our strategies. And I'd say there's three different types of data that we focus on. One is obviously the ESG data. That's very, very important. We take a multi-data approach here because there's many issues with ESG data. Can get into that later. But there's many issues there. We use a multi-data approach, and we really use this to assess the internal operations of the company. That's how we think of using ESG data. But then layering on that is the sustainability, the impact data to get this sense of how companies are impacting the world and society. So as I made a comment before, our research has shown how those two complement each other. So how we think about things is identifying those impactful companies, but then make sure that they're also being managed in a reliable way. That's how those two data points complement each other nicely there. But the third aspect of the data that we focus on as well is alpha insights or fundamentals. We can't lose sight that at the end of the day, we are active investors. We're not just identifying sustainable investments, we're identifying sustainable investments that are good investments that can actually outperform as well. So that's a key part that comes into the mix for us. And so it's that combination of those three elements when we're building our portfolios. But I also really agree with James's point as well. It's about the output as well, how data plays a role. And it's all in this environment now about that added transparency of products, how you demonstrate that you're not greenwashing. Are you really doing what you say you're doing? So it's about using the data to measure your exposures in your portfolios to demonstrate that consistency, the repeatability of the exposures as well. So that I like to James's point about the input-output aspect of the data.
So this leads me to a question that I think all of us have in our minds or have had at various different moments, which is these are very challenging equations to solve, as it were. By the time you add together all of the various different needs on one side, the information that you can get, how do you feel about existing ESG and sustainability data sets? Like, are they helping you meet the challenges that you have in these areas? And maybe Laetitia, we could start with you, since you sit in the middle of all this, and maybe you could give us a perspective on how is the ESG data faring, as we look at all of these challenges.
Well, first, I think it's fair to say that no data is perfect. So ESG data is not perfect. Financial data is not perfect. But
yes.
And something that is important for us when we look at data is who provides the data itself, and the users of the data. So who provides the data? It's important for us that the data provider is transparent enough, has clear methodologies, provides identifiable sources of information, so we can understand the rationales behind an ESG rating or an ESG score or something, and also that there is no conflict of interest from those that are providing data. And I think the UK is working on a code of conduct for ESG rating data providers. So looking forward to what's going to happen in that field. The second thing is the data as well. There's more focus, and it was already mentioned by Gavin and James earlier. But there's more focus also on the materiality of the data. So this is important. And we need to make sure that what is reported is material. There is also the question of the double materiality of things. There's a question of the depth of the data. And you can't have, and I'm sure you know that better than me, Patrick, but you can't have aggregated data if you don't have the granular data. So that's something that is very complicated to get. But there's always an element of judgment when it comes to ESG. There is always the question of values, of judgment. And I think we need to accept that at some point. This is how it's always going to be. So this is not perfect, but it's a judgment at some point. And last point is the question of the technology as well. I've started to get passionate around all these discussions around AI, but there's a lot of things that will change the world of data also in there. And last point, as I mentioned earlier, the users of the data are important as well, because we can criticize ESG data as much as we want. We can also criticize the users of the data if they don't understand it. and sometimes they don't. And you can't have everybody understand financial statements. You can't have everybody understand ESG data neither. So they need to be trained and they need to be educated as well.
Fascinating. It does come back to this idea of education among other issues that we've been seeing. So James, I'd like to put the question to you, since obviously in delivering what you're delivering to your clients, you have to source data from all of these places. How do you feel it's doing in terms of, is it up to the challenges that you face?
I think two really, really important points made by Laetitia. One, I would prefer not to be too critical about the state of ESG or sustainability data, non-financial data more broadly, because as Laetitia said, the vanilla parallels like accounting conventions, GAAP versus IFRS, as well as credit ratings more broadly, which have been around for far longer, are also still far from perfect. The second point about users, I kind of maybe would think about this as wrong way materiality. I have found in the past that some metrics which are designed for X are actually used for Y. And I think obviously ESG ratings are the best example of that. They are generally a good gauge of the impact that the world has on a company, rather than the other way around, which is, I think, if you were to ask your client or someone on the street, what they think sustainability data should be for, they would probably, think about making the world a better place. That would be the impact of the company on the world. That's not really what ESG ratings are designed to do. So that wrong way materiality is another issue. Probably the only other thing, Laetitia mentioned it, and at a high level as well, is gaps in reported data. I think Gavin said garbage in, garbage out. It's the same thing. I think stock exchanges, as well as engagement from investors like us, both important tools to try and improve the level of data that is reported, both the quality and the quantity of it. I mean, large companies in general already do a good job. Small companies, particularly in emerging markets, perhaps need some help on the engagement side as well as the stock exchange side. So, back to my first point overall, I think given that, this space, sustainability data more broadly, it's not been around for too long, years, most decade or two. I think that overall it's not a bad place to be. And as some others have said, regulation, I think, will make that better in the near future as well.
Thank you. It does seem like we're in for a marathon and not a sprint. I do believe it took several decades even for GAAP to become GAAP. So I think that's we're in for a steady journey of improvement, or at least let's hope so. Gavin, I'd like to refine the question a little bit for you, because it seems like we are talking about maybe places where there are gaps. It was garbage in, garbage out was at least in this conversation, you mentioned it first. I'm curious to know what are some of the gaps that you see, and I think we can establish that we're on the right path, but what are some of the areas that you feel we need most work in?
Yeah, so if I focus on the ESG data, it's coverage it's the most obvious and it's the biggest challenge with ESG data. It's self-disclosed data at the moment. You can have large portions of the universe where you don't have this data available. So that is problematic. Like, we've done work to help overcome that missing data, but it is difficult. So more data disclosed. Obviously, things like CSRD should help, but that's going to be something in the future in terms of helping address this. One of the other big challenges with ESG data is that where it is disclosed, there is actually a lot of data. Companies do disclose a lot of data, but I would argue there's a lot of meaningless data that companies disclose. And I say that because there's so much policy-based data that companies disclose. It's a binary metric. It's not actually saying they're doing anything real. It's almost more intention. So there's this abundance of data, but so much of it in the ESG space, which is just not meaningful. So we need to be encouraging companies to be disclosing more quantity-based metrics. That's what's truly meaningful. But the other big problem on the ESG side is just the comparability of data. Everyone's spoken of this a little bit already. Companies can be disclosing data on similar issues, but they're disclosing different metrics. So it's an apples to oranges comparison there, which can make your life very difficult when using ESG data. Now, that's just keeping in the ESG arena, I should say here. Now, there is this other area with ESG where people do use ESG or try to use ESG to link that to SDGs. For instance, try and use this to proxy for sustainability. we just think that's just calling ESG SDGs, and you're just getting something that's highly correlated with ESG on that front. The other reason why we don't like that path of using ESG to try and proxy for sustainability is, we don't think that's in the spirit of what SFDR is looking at when defining sustainable investments. But also, when you take this path, we feel this really constrains you much more to a corporate setting, in that a lot more ESG data is from corporates. And so if you're linking that to SDGs, you're just having a sense of impact related to corporates. Well, for us at PGIM Quantum, for asset owners, you're multi-asset, you invest across asset classes. You want to be thinking about how you can have an approach of thinking about sustainability across asset classes. So by using this ESG to SDG approach, we think that's very constraining. You need to be looking at different approaches to have that more scalable approach.
That's absolutely fascinating. I think one of the areas, this comes back to James's point, I think, as well, is if you ask a person what they think sustainability means, it comes down to this idea of the impact of the company on the world. Is it making the world better or worse? And that's something that we, obviously at UTIL, we're very familiar with and we strive for. I am curious to go a little bit deeper, Gavin, on your point about comparing apples to apples. These sort of differences in the types of disclosure, the choices that companies make. I'm curious, actually. Why don't we start with you, James? Let's, as you think about what companies are disclosing, that sort of angle. How do you know? I guess what the most credible data is that you have? I know this is there are a variety of sources out there. Is this one of your factors? Is this sort of comparability a big feature of what you're looking for?
So, I mean, we're a reasonably small, reasonably new operation, and at the moment have to rely on third-party data providers for almost all of our sustainability data needs. Talking about companies, the big name players, MSCI, Sustainalytics, Bloomberg, all of the above. So really, what we can do is simply engage with these larger players to try and better understand what they're doing, if they are engaging with companies to try and improve the process, as well as, importantly for some, how they are filling the gaps, whether it's using various machine learning tools or are they making assumptions, just so that we understand what's going on, so that we can communicate to our clients, this is exactly how this methodology works. This is, whether the data is reported well or not so well. So really, it's all about understanding. And then for us, perhaps what we are communicating, we have the option to go down a quantitative route, but also the qualitative route, talking really about reporting here. And for us, we found important to find a balance, because as much as I love going super deep into the thousands of metrics that are potentially material to our strategies, our funds, sometimes just a few metrics can tell a really powerful story. Better yet, if we can find an intuitive and exciting way to communicate what is quite a complex process under the hood. I'm kind of talking about UTIL here in terms of going from really our fund of funds to the fund, to the company, down to the product, then looking at whether the products are making a difference from an SDG point of view, positive and negative, importantly, aggregating all the way back up. And all of that process, really, we can communicate in a simple radial chart. And so, that's an example, perhaps, of not having to rely so much on company reported data, but still making a really impactful, creating a really impactful narrative for our clients.
That's really interesting. Laetitia, you perhaps have a slightly different perspective on this, sitting at the exchange. Obviously, you sort of see listing issuers, and then obviously the clients for the products and bonds from those issuers. Presumably that relates very closely to those company disclosures. Is there, when people complain about the inconsistencies across different types of disclosure from companies, do you see that at the exchange? And if so, how do you handle it, or are there good reasons for there to be differences?
Yeah, well, we are, as I explained earlier, we're very much centered on sustainable debt securities. So that's the kind of reporting that we look at. They come in various shapes and forms. Even if the ICMA green bond principles, for example, are quite standardized, there are 4 dimensions that need to be analyzed. Usually we find this information in the documents of the issuers, but the way it's reported is very different. So you can have issuers reporting on a pool of bonds or a pool of projects. The pool of bonds and pool of projects don't match. Figures don't match. there's a projects that have been several times financed, and so you can't really tell which bonus financed which project. So there's a lot of limitations in there, but we see an improvement in that. There is a more of a standardization of this type of documents, especially the frameworks. And I hope that with the EU Green Bond Standard that provides templates for the issuers of bonds, that more and more issuers will use those templates, and that the information will be more standardized. But one point on the limitation that was not mentioned before, that is very close to my heart as a former auditor, is the verification of the data. And well, this is going to change most probably with CSRD and also with the UGBS regulation, but verification is absolutely crucial. It's paramount to the credibility of the data that is being disclosed. And if that does not happen, then we can't really sometimes differentiate a document from marketing or communication document from a really sustainability report where you need data there. So that verification, whether it's on quantitative aspects or qualitative aspects of the information featured, is absolutely key. And I'm quite glad actually to read that in the last month, actually, the International Assurance Standard Board is consulting on a new sustainability reporting, sustainability verification standard, sorry. So this is sometimes overlooked, not that much mentioned, also in the reports. Some issuers have verification, but not all of them, third-party verification, I mean. But this is not yet market practice, I believe, and it should be.
And that's very interesting, and it accounts for some of the differences that we keep seeing. And obviously, it's in the meantime, it's up to some combination of market participants and regulators to figure out the best way through. But you also mentioned this. The combination of quantitative and qualitative data, and maybe Gavin, since it comes to, since obviously your work is quantitative, I'm very curious to know, how do you see the tension between this combination of data that we want to be increasingly quantitative, and this sort of, there's plenty of qualitative data out there. How do you resolve that tension if you do?
Yeah. Well, we clearly like the quantitative data best. That's, we are quants. The quantitative data works best for us. We think that sort of data is most repeatable and consistent through time. But we also find that with the quantitative data, there tends to be better coverage as well, which is key. And so if you're thinking of that point, we want better coverage, because if we're trying to do something like identify sustainable investments with this data, we want the broadest universe as possible. And the reason for that is obviously, as we're looking at different products nowadays, there's requirements of say 100% exposed to sustainable investments. If I'm holding a very diversified portfolio, I need to identify as many sustainable investments as possible to satisfy that diversified portfolio. So that quantitative data really helps on that front. But also with quantitative data, you can typically get a better history of this data as well for backtesting. So in this environment where, again, we're building strategies with strict features in them to satisfy regulatory requirements, we want to have confidence that these features deliver the outcomes that our investors want. We want to be able to backtest that. So that quantitative data really does help on that front as well. But again, when you're seeing certain quantitative data as well, I made the point before about being scalable. If it's quantitative data generated from different technologies, we think these sorts of approaches, you can better scale those ideas, those measures across asset classes in a bit of an easier way than what you could with a strict qualitative approach. Now, yes, a pushback on quantitative approaches in this space can be transparency, but it's as good as your methodologies underlying them. So if you've got good methodologies, you can have that transparency to appease your investors.
It might also be worth adding that data is only one part of the story. It's also, in some cases, about holding companies to account, Laetitia, to continue, your bid on fixed income. There are lots of different instruments. It's actually a really colorful space from a sustainability point of view at the moment, but some instruments are better than other. And even for something like a sustainability linked bond, if the data is there and the verification is even there, we found that some SLBs tend to not stand up from just like an ambition point of view or a materiality point of view. And data can help to inform our opinion as to whether or not something is important to the company's bottom line, is ambitious enough. So maybe worth just emphasizing that data can also be used in that sense to identify where a company or even a government can be doing a little more.
That's really interesting. And it seems like there is a sort of combination. It seems like quantitative data has its advantages, obviously. And we at UTIL have deep sympathies, because this is why we've done what we've done in the ways that we've done it, specifically. But there is, I think, as we go through, and it has always been true to varying degrees in finance overall, that there is a qualitative component. I think there's a necessary kind of element of human judgment in various different areas. So not all, but certainly plenty. But speaking of sort of Laetitia, go ahead, please.
No, if I can just add something on that as well. There's a little caveat also, where I believe that, although I'm very much in favor of quantitative data as well, I like where there is a context and explanations as well. And I think that where we can use quantitative data is probably for data that is more operationable, if that's an English word.
It is now.
It is now. Like GHG emissions, for example. Because people have been used to reporting on that. They know the methodologies. Usually they use the GHG international protocol, so that's fine enough. But for example, for human rights type of information, you need probably a bit more context. So it really depends on the data sets, whether you can only use quantitative data or quantitative and qualitative, or only qualitative when the other does not exist.
Mm-hmm. Oh, that's interesting. Well, and an area of data that I think sort of sits as a kind of slightly different category. Much of it is quantitative, but I'm very curious to know whether any of you have explored kind of integrated data sets or even alternative data sets. There are plenty of examples, for instance, of commodities being monitored from satellites, crop yields. There's all kinds of imaginative and colorful ways to do this. I'm curious to know if that's something that you're exploring. James, maybe we could start with you, and if that's something your clients are interested, to go back to your idea of straightforward narratives. Is that something that complicates it too much, or is it something that might be worthwhile exploring?
So it's probably a good next step, having established a foundation of understanding with our clients. I think one of the disadvantages of most sustainability data that we maybe not touched on is that the ratings, especially, but also other metrics, carbon emissions, tend to be backward looking. Mm-hmm. And so where we might need alternative data is when we try to look forwards. And so we've been exploring things like climate or carbon, value at risk, temperature alignment. Now, there are pros and cons to these methodologies. Lots of assumptions go into them. So it's been really a period of exploration more than anything. That's more on the climate science side than anything, trying to mitigate risks rather than perhaps to make the world a slightly better place. But, if I could call UTIL's data set, a source of alternative data for us, certainly more colorful than some of the other providers that we've used so far. I mean, for us, measuring real world outcomes is super important because, as we've discussed, most clients, it's really what they care about. So we've spent a considerable amount of time trying to find the best way to communicate these outcomes, conscious that there are several layers of separation between one of our clients' investments and actually where capital is allocated when we think about client, IFA, us, fund, company, etc. So, the SDGs, useful conduit to communicate that data, easy to understand, exciting to talk about, mindful that also that this methodology, this framework wasn't originally designed to be used by investors like us. Well, in any case, we trialed a few SDG data sets to begin with over the last kind of 6 or 9 months. And to be transparent, we were skeptical of some of the results, which in some cases showed that our strategies were super significantly positively aligned to all of the SDGs, and that would be great if it were true. But we found the conclusions, given what I said about the layers of separation, perhaps a little too good to be true. One of the reasons that we really like UTIL's data set is, one, the transparency of the methodology, as I said, down from fund of funds all the way to product and back up, but also that the output is what we see as a more fair reflection of what allocating capital on secondary markets is really like. You know, there is some positive alignment to each of the SDGs. There is also importantly some negative alignment, and then overall you get a good picture. And for us, that's probably the best example of new or alternative data that we've been using recently.
That is wonderful to hear, and obviously we're very excited about the work that we do, but it's also great to hear that others are excited about it too. Laetitia, maybe I could turn to you for a second to talk a little bit about whether you see alternative data in the exchange, and particularly with issuers, whether it's something that gets used a lot, and then maybe we can turn to Gavin after that. But Laetitia, why don't you go first?
Yeah, so, well, first I can only echo what James said on the UTIL data. I think we like the fact that it's transparent and gives a fair representation. There's less bias, to me, from what companies say when looking at your data. So that's one thing. Well, we've been approached, or we're very regularly approached by data providers who want to show us their methodologies. We've been approached by companies that operate satellites and drones to monitor the projects and the impact of the projects. For the time being, we don't go that route because it's only one set of information, images that you can have on a project. That's interesting, for example, for forestry projects, for example, but not for all projects. So not very easy to only add that little piece into a bigger data set. And I guess that's a very important point, is that there's so many data sets available now that it's a bit overwhelming, and to choose which one is the best one, covers the best universe, as Gavin mentioned. So a bit complicated to do that. And I tend to believe that you don't have to have that many data sources. Maybe one point is to stay focused on what exactly you want to test. Stay focused on that, because otherwise there are so many things and you don't really know, you don't understand, but you try to integrate so many ESG data in there. So that's another point. And on the alternative elements, well, I mentioned at the beginning, I've had a very interesting discussions around the artificial intelligence. We tried internally, secretly ChatGPT 4 on some documents, and amazing as well. So I very much look forward to what all of that can bring to the market when it comes to data. There will be risks for sure. There will be limitations. There will be, but that's also very disruptive.
Absolutely. Likewise. Well, Gavin, maybe a few words from you on alternative data, and then we can turn to the audience for questions. But what do you see alternative data, and how does that factor in?
Yeah, there's been two areas that, always on our radar. On the ESG side, always thinking how we can be getting access to more dynamic insights. Because this issue that so much of the data comes up with so much of a lag, it can be 18 plus months old before you can start using that data. So always looking at different insights that comprise more dynamic insights around how the ESG profile of a company is changing. So this could be more NLP, machine learning based approaches of extracting insights from news stories and so forth. That's always a very interesting area for us. But the other area of looking at newer alternative data sets, those that help offer insights into transitional or physical climate risks for companies. That's just such a big issue for people focusing on today in terms of investor interest. If you do the UNPRI, the prominence of that, it's just a big issue. It's going to become more important. It's a complex area to model. So looking for that different data to help on that front. And then, of course, our similar support for impact and UTIL as well, and the onboarding of that data.
Oh, that's wonderful. Thank you. Well, with that, we do have a few minutes left before the top of the hour, and I'd like to open us up to further questions from our audience. So I will here open our Q&A. But are there any particular questions from our attendees for the panelists? So we have experts from various different fields. We've already gained a lot of insight from all three of them. But let's turn to the audience in case we have any questions. I should say. Excuse me. So our first question actually returns to a topic we did touch on, which is if every company is making its own decision. This is from Weil, to making its own decision as to what's material to its operation. So company determined disclosures. How do we compare apples to apples? We've got if companies choose what to disclose, how do we then make that somewhat more standardized? So Laetitia, why don't you go first?
Yeah, well, that's a very relevant question. And as a former advisor also on sustainable finance, I've done several material assessments, materiality analysis for companies. And you're not supposed to only look at what is material to the company. You're supposed to look at what's material to the stakeholders of the company. Obviously, there will be a dimension of what, and that should be there. What's material to the company, what is material to the stakeholders as well. And if you have investors as stakeholders, this should also be taken into consideration. And last, for example, on the bond side, you've got second-party opinion providers who assess the level of materiality of what you're reporting. And James mentioned the SLBs and the credibility of those targets and KPIs. SPOs are also supposed to look at the materiality of these KPIs as well. That's a core element of the sustainability linked bond principles of ICMA.
Oh, that's fascinating. Well, and James, how about you? How do you approach making all of this consistent, as it were, across different different ways that companies essentially different ways that companies speak about themselves?
So, I mean, reliance on all of the acronyms that we've not yet discussed, ISSB and all the other international frameworks that hopefully will arrive at a common set of disclosure, points, etc. And then on our side, we can look at what I call materiality maps. SASB, Sustainability Accounting Standards Board, and a few others have tools that we as investors can use to decide at a sector or at a country level which bits of ES or G data are more or most relevant, and then we can hopefully get everything into an apples to apples comparison. So that's kind of how we're going about it.
Very interesting. Gavin, how about you?
So yeah, I'll just come at this slightly different in that, let's say in a certain industry, there's some rough consensus on what is material. There's actually, and if a company is not disclosing that issue, there's actually information in that. So when companies are choosing not to disclose certain things, we can take advantage of that in terms of what they might be trying to obfuscate from investors. So if you approach this from a different angle, you can still take advantage of that and exploit that as an investor.
Oh, very interesting. Well, looking at the 3 minutes that we have left, I'd like to close with a question. Obviously, we've got three wonderful experts with us here today. So as experts, what advice would you have for those who are just starting to factor sustainable investing into their strategies? And maybe, Gavin, we could start with you. What would you say to someone just beginning?
Yeah, I'll just reinforce three themes that have come up today. Invest in that data that is specific to ESG and impact. They are distinct ideas. You'll get quality data, quality insights by doing that. Second is transparency. You need to be focusing on transparency as you're incorporating this to be able to show to people how it's impacting portfolio positioning, performance. If you can't do that, it's just a story that you're telling. And the last point is, again, coming back to an earlier point I made, we're not just identifying good ESG or ESG investments or sustainable investments, they're those which are good investments as well. So we're trying to outperform as well. So always keep that in mind. So those 3 points.
That is great. Thank you. James, how about you?
I mean, to sum those words up into a phrase, it would really be just determine your purpose. You know, dozens of data providers, hundreds, if not thousands of data points, mostly do different things. And we've talked about a few of those. Ultimately, determine what you're trying to achieve before picking a data provider or a data set. And then perhaps relatedly, we try to not use data sets that we don't fully understand. You know, it's one thing having this really cool tool available to you, but if it's a black box or if you're not confident in the data set, whether it be backwards looking or forwards looking, we try to err on the side of let's wait and see, explore others around, and then see if there's something better. So one, determine the purpose, and two, keep it simple.
That's great. I love that. Laetitia, very much sort of last but not least, what advice would you give?
Well, I guess I would have 3 different advices. First one is don't take everything for granted. Don't take data for granted. Just challenge it. Challenge the scores, the ratings that you have. It's not the Graal. You have to understand it. Second point, stay focused. it was already mentioned, but you have to stay focused. You have to understand what is material. You don't have to report on hundreds of data points. You have to report on what is material. And last advice is train the people who are going to use the data. They need to understand it, because otherwise you run the risk of being exposed to greenwashing. If people don't know how to understand the ESG data that they manipulate, then you may well be in a situation that you don't want to be, and that's greenwashing. So train your people. Okay,
that is very helpful. Well, thank you all three. I'm immensely grateful that you participated today in our first ever webinar. It was a great pleasure, and I've certainly gathered a lot of insight from our conversation. Thank you all so much for being with us. Thank you to our attendees for being with us. I hope it's been interesting and valuable to you all. And I look forward to our next webinar. And this was absolutely wonderful. So thank you all for your amazing input. And I'm immensely grateful. And thanks again.